Welcome back to Economic Insights. I'm Alex, and joining me as always is Selim, market veteran, show producer, and the man who apparently doesn't sleep. Selim, quite a week.
It was a busy week, Alex. We had central banks moving in every direction, oil flirting with catastrophe, the UAE walking out of a 6-decade-old oil cartel, and the Fed's own board basically trolling its incoming chair before he's even been sworn in.
Right, so plenty to get through. Let's start with the big picture, the week that was. Walk us through it. Where did the week begin?
Iran opened the week by putting a fresh proposal on the table, offering to discuss reopening the Strait of Hormuz while kicking the nuclear can down the road. Washington looked at it, said, "Not good enough," and kept its red lines firmly in place. So the blockade holds. Oil market tension held with it.
And then midweek is where things really escalated?
Midweek was the main event. Three things happened that each deserved a week of their own. First, the Fed met, held rates as expected, but four members dissented. That's the highest number of dissents since 1992. We'll get into what that means in a moment. Second, the UAE announced it's leaving OPEC. Just like that, gone. And third, US Central Command was reportedly putting together a short and powerful military strike package against Iran. That sent oil to its highest intraday level since this whole conflict began.
And then the weekend rescue?
Late in the week, things calmed down. Iran floated a revised proposal, oil pulled back sharply, the ECB and Bank of England both held rates, and didn't sound as scary as markets feared. European bonds had a good day. And then Apple earnings came in strong. US jobless claims hit their lowest since 1969. And the S&P 500 closed out its best month since November 2020.
So the week ended, well, despite everything?
The week ended well. The underlying risks, however, did not go away.
Before we dig into central banks, let's talk about that S&P number. Earnings have been strong?
Remarkably so. About half of global companies have reported. In the US, 80% of S&P 500 names beat earnings estimates, with aggregate earnings growth of 31% year over year. Tech, communication services, the Magnificent Seven, they're doing the heavy lifting, accounting for two-thirds of that growth. Europe posted a more modest 5%. Japan surprised with 18% net profit growth.
Let's go to the Fed, because 4 dissents is a big deal, right?
It really is. The FOMC voted 8-4 to hold rates and kept its so-called easing bias, the language in the statement that leaves the door open to future rate cuts. But three regional Fed presidents dissented because they wanted that language removed entirely. They think it's the wrong signal given where inflation is. One governor went the other way and wanted an immediate cut.
So is the committee all over the place?
Here's what makes this interesting politically. Kevin Warsh, who's just been confirmed by the Senate Banking Committee, is expected to be sworn in as Fed chair before the June meeting. These three hawkish dissents are effectively the committee's existing members telling Warsh on day one, "We're independent, we follow data, and we are not rolling over for political pressure to cut rates." It's a preemptive message.
What does Warsh actually stand for?
Warsh is expected to prioritize shrinking the Fed's balance sheet over cutting interest rates. He's also signaled interest in alternative inflation measures, things like trimmed mean PCE rather than the standard headline number, and he may reduce the amount of forward guidance the Fed gives, which markets rely on heavily. This is a potential regime shift, and the hawks on the committee are essentially telling him they'll hold him to a rigorous standard.
And Powell himself?
Powell announced he's staying on the board as a governor, not leaving the institution entirely. He said he wants to oversee an ongoing investigation into the Fed's building renovation and that he wants to protect the institution's independence. Whether you believe that reason or not, the effect is the same. He'll be in the room.
U.S. economy broadly, right? Where does it stand?
GDP grew 2.0% annualized in Q1, which is solid. Consumer spending is growing but increasingly reliant on savings rather than income. The personal saving rate dropped to 3.6%, the lowest since late 2022. Core PCE inflation is at 3.2%, headline at 3.5%. Gasoline is up over 40% since the conflict began. the labor market is tight. Claims hit 1969 lows. The picture is resilient economy, sticky inflation, hawkish Fed. Rate cuts are being pushed further and further out. Some forecasters now see no cuts until late 2026 or even 2027.
Let's go to Europe. The ECB held, but the message?
The ECB held its main rate at 2.0% and called it an informational hold, meaning we don't have enough data yet to act. But Lagarde's press conference was unambiguously hawkish. She confirmed the council actually debated a rate hike at this meeting. They expect to have enough information by June to act. Markets are now pricing in 25 basis point hikes in June and potentially beyond, targeting a terminal rate around 2.50%.
And the economy underneath that?
Weak. Eurozone GDP grew 0.1% quarter on quarter in Q1. Ireland and France were drags, Spain and Germany slightly better. Headline inflation accelerated to 3.0% year over year in April, driven by a near 11% spike in energy prices. Core actually eased slightly to 2.2%. The ECB is hiking into slowing growth because it cannot allow energy driven inflation to become entrenched. That's the classic stagflation bind.
And Trump threatening to raise car tariffs on Europe to 25%?
Yes, he announced that at the end of the week. European equities took it on the chin briefly, then recovered along with everything else. But this adds to the pressure on an economy that is already running on fumes. The EU is advancing its single market roadmap and something called the Accelerate EU program for energy security. But those are medium term fixes. Right now, Europe is in a tough spot.
Bank of England?
The BOE held at 3.75%, 8 to 1 vote. The sole dissenter wanted a hike. Governor Bailey called it an active hold, meaning they're ready to move but need more data. The BOE is doing something interesting. Instead of a single forecast, they are working with three scenarios based on how long the energy shock lasts and whether second round inflation effects materialize. In their central scenario, inflation peaks around 3.7% in late 2026. In a severe scenario, it spikes above 6%. That latter one would force significant tightening. Markets are split. Some see an extended hold, others see a hike as early as July.
And gilt yields are surging?
Post war highs, actually. It's a combination of monetary policy expectations and political uncertainty. UK local elections on May 7th. Labour is expected to lose heavily across English councils, Scotland and Wales. If the results are bad enough, there's chatter about a leadership contest. That's a fiscal credibility risk, and the gilt market is pricing some of that in.
Bank of Japan, what happened there?
The BOJ held steady, but this was a heavily divided meeting. 3 of the 9 board members voted to hike immediately. The bank also removed language from its guidance, saying rate hikes would only come alongside improving economic conditions. That's a signal they're willing to hike even if growth slows, provided inflation justifies it. They revised their inflation forecast sharply higher.
So, why didn't they hike?
Government pressure, primarily. The current administration has effectively handed the BOJ what analysts are calling a dual mandate: stable prices and strong growth. That makes the independent hawks on the board frustrated, but the majority aligned with the government's preference to protect the capital expenditure cycle. June or July is the next live date for a hike.
And the yen, you mentioned the intervention?
Yes, the Ministry of Finance sold an estimated 5 to 6 trillion yen worth of dollars after dollar yen broke through the 160 level. It put a short-term floor under the yen. But the structural picture hasn't changed. Real rates in Japan remain deeply negative. The interest rate differential with the US is enormous, and the medium-term outlook for the yen remains bearish unless we see either a significant BOJ tightening cycle or a sustained decline in US yields.
Bank of Canada?
Held at 2.25%, maintained flexibility, revised their inflation forecast upward to 2.3% due to higher oil prices. A steeper yield curve followed. The Canadian dollar is getting mixed signals. Higher oil prices help it as an energy exporter, but the looming USMCA review and potential US tariffs create headwinds.
Let's talk oil, because the Strait of Hormuz is really the central actor in all of this.
It is. Here's the math. Iran's oil is flowing at roughly a quarter of its normal pace. The US Navy is actively intercepting dark fleet vessels. Global oil inventories are being drawn down as the primary shock absorber, but analysts estimate only around zero point 0.8 billion barrels out of 8.4 billion total global stocks are truly accessible without breaking refining and pipeline systems. The market is now balancing through price, but this is demand destruction. Global oil demand fell an estimated 4.3 million barrels per day in April. US gasoline prices are up over 42% since the conflict began.
And the UAE leaving OPEC?
This is significant on multiple levels. On the surface, it's an economic decision. The UAE has been frustrated for years with production quotas that constrain its capacity expansion ambitions. It also has long standing tensions with Saudi Arabia over those quotas and influence within the group. But the timing matters. Exiting OPEC, while Iran is constrained by a blockade, and while Iran has exerted influence over the strait, is also a geopolitical signal. The UAE is effectively stepping away from the Arab oil bloc's collective posture and charting its own course. Don't read this as purely about barrels.
Gold?
Gold's share of global central bank reserves has doubled over 4 years to nearly 30%, driven overwhelmingly by emerging market central banks wanting assets that can't be frozen by sanctions. Some projections suggest gold could reach $8,000 an ounce over 5 years if EM central banks target a 40% reserve allocation, which is where some appear to be heading.
Dollar?
The dollar has regained some ground. Long-term structural picture is bearish. Its share of global reserves has fallen from around 60% to roughly 40% over time. But near-term US economic outperformance, a hawkish Fed, and weak data out of Europe are providing support. May is historically a strong month for the dollar seasonally. Hedge funds have been buying it against emerging market currencies. Real money investors have been selling it. An interesting divergence.
Emerging markets? Where do we start?
Start with the bifurcation. The Middle East shock is hitting oil importers hard and helping oil exporters. In Asia specifically, you have tech exporters, South Korea, Taiwan, Malaysia, holding up well because AI related exports are booming. Then you have India, Indonesia, the Philippines, heavy oil importers facing currency pressure, inflation, and central bank tightening.
China first?
China had a good Q1. GDP grew 5.0% year on year, beating expectations. The April Politburo meeting signaled increased confidence. Industrial profits up 15.5%. But it's all concentrated in tech, non ferrous metals, and exports. Domestic consumption and property remain weak. The central bank is actually draining liquidity to curb financial leverage, not easing. No broad stimulus is coming. The Politburo is focused on energy security and industrial policy. The yuan is stable, managed through the daily fix.
India?
Industrial production growth slowed to 4.1% year on year in March. The broader cyclical upturn had already been fading before the conflict intensified. Higher oil prices are squeezing the current account, and inflation is being revised upward. India is more exposed to the energy shock than China given its import dependence, and analysts are cutting their growth forecasts accordingly.
Turkey?
Turkey's central bank's priority is containing dollarization. Inflation is expected to accelerate further due to energy and utility price increases. The trade deficit hit its widest level in nearly a year. Export volumes are falling, particularly to the Middle East and North Africa, which is a direct casualty of the regional chaos. If oil persistently trades at $130 a barrel, Turkey's current account deficit could reach 5% of GDP. Long lira positions are less attractive on a risk reward basis.
South Africa?
First quarter's GDP tracking below expectations. Manufacturing and trade are weak. But the more pressing development, the central bank has turned hawkish and is expected to hike rates following upside surprises in core inflation, driven by housing and wages. The rand remains sensitive to global commodity swings and is considered expensive relative to fair value.
Egypt? GCC?
Egypt is navigating a difficult path between high energy import costs and limited fiscal room. GCC broadly is exposed to jet fuel costs through its tourism heavy economies, and the Saudi economy actually contracted 1.5% sequentially in Q1 due to lower oil production levels. Saudi equities, however, are seen as a trade on higher for longer oil, and as we mentioned, the UAE just rewrote the energy geopolitics of the Gulf by leaving OPEC.
Latin America? Anything worth flagging?
Two contrasting stories. Brazil cut rates 25 basis points, but the statement was hawkish. They're worried about oil driven second round inflation and revised their 2026 inflation forecast up to 4.6%. Future cuts will be slow or may pause entirely. The irony is that Brazil is a net oil exporter, so higher prices are actually boosting growth. GDP forecast nudged up to 1.9%. But the inflation spillover is complicating the easing path. Meanwhile, the government is rolling out fuel subsidies and stimulus programs, which itself adds inflationary pressure. Brazil is trying to cut rates and stimulate at the same time, while inflation is rising. That's a difficult needle to thread. Mexico, on the other hand, is expected to deliver what may be its final rate cut of this cycle, 25 basis points to 6.5% next week. GDP contracted 0.8% quarter on quarter. The economy is struggling under investment uncertainty, and the central bank is likely done easing after this move.
What's coming next week?
The single biggest number will be Friday's non farm payrolls report. Consensus is somewhere between 50,000 and 100,000 jobs being added, much lower than March's 178,000, which was a warm weather pull forward. Unemployment expected to hold around 4.3%. That number will set the tone for how the new Warsh era Fed is greeted.
Any central banks?
The Reserve Bank of Australia is expected to hike 25 basis points. Persistent inflation, tight labor market. Mexico's Banxico expected to cut 25 basis points. The BOJ releases minutes from its March meeting.
Geopolitically?
OPEC Plus meets this Sunday, the first meeting after the UAE's exit, which will be a test of group cohesion. UK local elections on Thursday, and markets will be watching any signal from Tehran or Washington on whether the revised Iranian proposal is gaining traction. The blockade continues to be the single biggest macro risk in the system.
Earnings?
AMD, Palantir, Disney, McDonald's, Berkshire, Toyota, Sony, Shell, and Rheinmetall. That last one a reminder that defense spending is very much a growth story right now.
All right, that's our week. Selim, as always, an education.
Always a pleasure, Alex.
Don't forget, folks, we do not give investment advice. For that, please consult a professional. We'll see you next week.